Still have those notes with you. We're going to continue where we left off. We do have a couple extras, and if somebody did not bring theirs, somebody need a chapter 11. Very good. All right, so where we left off in chapter 11, we were talking about depreciation, and we were talking about how it's a method of allocation and not of valuation, because basically we're spreading these costs over the period of time over which we think revenue is going to be created from these assets. Because the matching principle tells us we want to match the expenses with the revenues, and so that's what depreciation is all about. And as long as two things are true, we can use any depreciation method we want. And the two things that need to be true is that the method is systematic and rational. Those are the two things that must be true for us to be able to use a method. And so I think we already talked about the straight line method. Is that right? Okay. Did we talk about some of the year's digits yet? No? Okay, I mentioned it because you know it's on the exam, but I'll talk through the mechanics of it. Have you guys learned some of the year's digits previously? Maybe?
Almost science technology.
Okay. Well, it's really easy, so we'll go through it really quick. Basically, the idea behind some of the year's digits is that the depreciation expense is going to be the historical cost minus the residual value, so this same number that we used for a straight line, but instead of taking 1 divided by the number of years of useful life, which is what the straight line does, instead what we do is on the top we have the number of years remaining, and on the bottom we have the sum of all of the numbers of the years. In other words, if we have 5 years, then it would be 5 plus 4 plus 3 plus 2 plus 1. That's the number that's on the bottom. The sum of the year's digits, that's the number that goes on the bottom. So the first year would be 5 divided by 15. The second year would be 4 divided by 15, 3 divided by 15, 2 divided by 15, 1 divided by 15. Add up all those numbers, that equals the same as what's on the bottom. It ends up that you depreciate this full amount just like you would up here. We'll do an example on the next page. This equation that I have right here gives you the exact same number as if you were to take 5 plus 4 plus 3 plus 2 plus 1. It is 5 plus 1 is 6. 6 times 5 is 30 divided by 2 is 15. You get the same number. And it works for all of them, any number that you choose. So let's say it's 4 years. It would be 4 plus 3 plus 2 plus 1, which is 10. And then if you take 4 times 5 is 20 divided by 2 is 10. And it always works. So you can use this equation or just add them up. Either way, it's just fine. And then that's going to be the number of, that's the amount of depreciation each period. It's good to have the most in the first period, less the second period, less the third period, and then the least in the last period. So it's an accelerated depreciation method. More depreciation early, less later. The reasoning behind that, or the rationale for doing something like this, is what we talked about last time, is if we think we are using up the asset more early, or we're getting more benefit early, so it creates more revenue early and less later, this makes sense to use this type of method. And I believe we talked about that technology is usually the types of assets that we use this method on, or any kind of accelerated method on. All right, so that's some of the year's digits, and we'll do an example on the next page. The last one, the third, we have one more on the next page. The third method that we'll talk about is the declining balance method. And probably you've all learned the double declining balance method. Is that true? Okay, some of you are looking at me like I'm crazy. Okay, well, I'm going to assume that at some point in your accounting careers you probably learned this. So the way I have it written here is kind of a general format. This could be double declining, or triple declining, or 1.75 declining, or 1.5 declining, or any other number you want. It works for all of them. It's usually going to be done as double declining, and we'll talk about that specific case, what it looks like. The basic way you do it is the depreciation expense in any period is going to be your beginning net book value. Okay, so this is not the same as this number right here. This right here is what we call our depreciable base. This and this are the same thing. That's a depreciable base. What is this number? It's the historical cost minus accumulated depreciation. Is this number going to change? Yes, every year. As you have depreciation, this number gets smaller. So we have this number that gets smaller every period. and we're going to multiply it by a declining balance rate. A declining balance rate in its general form looks like, let's see if I have this written down here. No, I don't. So in general form is going to be some number divided by the number of years of useful life. So for example, if this is double declining balance, it would be 2 divided by the number of years of useful life. If this was quadruple declining, it would be 4 divided by the number of years of useful life. There's no rule that says it has to be double declining. This is just something someone picked out of the top of their head, and that's fine, but you could use any other number, would be just as reasonable as double declining. So 2 divided by the number of years of useful life is double declining. There's a typo here. This should be accumulated depreciation. Sorry about that. Ending net book value should be greater or equal to the residual value. So one thing you'll notice in this equation is there's no residual value anywhere. So you could, in theory, depreciate it past the residual value down to 0, but we don't do that. When we use the double declining or any declining balance method, we're going to use this equation until we hit our residual value, and we're going to stop depreciating at that point. And we're going to limit our depreciation until we hit our residual value. We'll do an example on the next page, and we'll be really happy sometime got. And then when the declining balance rate is twice the straight line rate, the method is called the double declining balance method, and that's the one that we're going to be doing. The last method, which is on the top of this next page, the first 3 are all time-based. As time passes, we depreciate the asset. This last one is activity-based. It's called units of production. With units of production, once again, you take your depreciable base, the historical cost minus the residual value, and then we multiply that depreciable base by this ratio of the units produced this year on the top and the total amount of units expected to be produced with this equipment by your firm on the bottom. So total units estimated to be produced in the total life of the asset on the bottom, and the amount you actually used up in this period on the top. Does that make sense?
Mm-hmm.
Okay. We're going to do an example?
Yes.
So a bunch of this is review. We're going to add a layer to this on the next page, so it does get slightly harder on the next page. A $200,000 piece of equipment is acquired at the beginning of 2001 for cash. The residual value is estimated to be $50,000 after a useful life of 5 years. So the $50,000 is an estimate. We think it's going to be worth $50,000. We can sell it for $50,000 in 5 years. We think we're going to use it for 5 years. That's also an estimate. The equipment will produce approximately 55,000 units over its useful life. That's an estimate. And then it ends up that this is how many units we actually produce in all of these various years. This information is obviously going to be used for the units of production method that we'll do as our last one. So we're going to depreciate it over these 5 years, and we're going to figure out how much depreciation we have in each year and then the total for each of these 4 methods that we have. So we'll start with straight line, and we'll use the equation that we had on the previous page, which is the historical cost, which is 200,000. We're going to subtract the salvage value or the residual value, which is an estimate of this 50,000. Our depreciable base is how much?
150,000.
150. In other words, for all of these methods, that's going to be the total depreciation expense. We want to depreciate it from the 200 it is now to our residual value of 50. That difference of 150 is how much for all of these are going to depreciate this asset. That's how much, in other words, that's how much we're allocating to these 5 years using one of these methods. We're allocating 150,000 to these 5 years in some way. Divide that by 5, and for straight line, you're going to have 30,000 each year as the amount of depreciation equal each period for a total of 150,000 of depreciation. I won't write the journal entry because you all know the journal entry, but I will say it out loud. Debit depreciation expense, credit accumulated depreciation, 30,000. At the end of each period, it's an adjusting entry that happens on December 31st. Okay, let's do sum of the year's digits. With sum of the year's digits, we are going to start with our depreciable base of 150,000, and then we're going to multiply that by a ratio. On the bottom is the sum of the year's digits. And it just so happens that I picked 5 as my example when I talked about it, and this happens to be 5. So we're going to take 5 plus 4 plus 3 plus 2 plus 1, that equals 15. 15 goes on the bottom. We're in our first year, so we have 5 years remaining to depreciate it. So we've got 5 on the top. Our first year's depreciation is going to be 50,000. Our second year, we're still going to have 150,000. That doesn't change. But now we only have 4 years remaining, and so we're going to have 40,000 in depreciation. And then we're going to have 3 years remaining and get 30,000, etc. Okay, so we have 50 plus 40 plus 30 plus 20 plus 10. It's not a coincidence. That equals 150,000. So this is just another way of spreading that 150,000 of costs associated with this piece of equipment over these 5 years. What we're saying here is that we're getting more benefit from it early and less later. So it makes sense to have more depreciation early to match to more revenue and less depreciation later to match to less revenue. Does that make sense? They look like zombies, a little bit like zombies right now. Fortunately, I think I'm going to have to get used to that because that's how I think this semester's going to go. Usually I like to wait and make sure you understand, but I don't think I can do that. We just don't have time. So if you aren't getting something, I will stick around after class and during breaks and before class. I'm happy to help you out, but we really will have to kind of push fast through this stuff. Double declining. Double declining, we ignore the salvage value, at least initially. The equation says you take the historical cost minus accumulated depreciation, also known as the book value, and in this case, it is currently 200,000 because we have no accumulated depreciation. And then we multiply that by 2 divided by the number of years of useful life, 5. So multiplied by 2 divided by 5, and that's going to give us depreciation in our first year of 80,000. Does that make sense to everybody?
How do you get a 2 or 5?
How do I get what now?
A 2 or 5?
So the double declining means double 2 on the top, that's the 2. If it was triple declining, it would be a 3 on the top. But it's double declining, so it's 2. And the bottom is always the number of years of useful life. Another way of saying that is, well, that's the easiest. We'll go with that. We'll do that. What is our book value at the beginning of 2002? 120, right? Because we now have accumulated depreciation of 80,000. Take our historical cost of 200 minus accumulated depreciation of 80, and we now have 120,000 as our book value. Multiply that by 2 divided by 5, and that is going to give us 48,000 of depreciation. So you'll notice that for this method, these numbers are changing, and for this method, these numbers are changing. Try not to get them confused and mixed up. That would be bad. A little bit of practice will help you with that. In our third year, our book value is now 120 minus 48, which is 72,000. Multiply that by 2 divided by 5, and that gives us 28,800. But we have a problem. What's our problem?
A residual value.
Our salvage value is how much? 50,000. If we depreciate at 28,800, what will our book value be? It'll be less than 50,000, which we can't do. So this is not how much we're going to depreciate. We'll put a big X through that number. We can't depreciate it that much. We're going to depreciate it as much as we can without taking it below the salvage value. What is the maximum amount we can depreciate this asset?
22.
2,000.
How much?
2,000.
Not 2,000.
22.
22,000, right? 72 down to 50, 22,000. 22,000 is the amount we can depreciate it because it'll take the 72 book value down to 50. We'll do that. And so our new book value will be 50. How much depreciation are we going to have in this year? 0. How much do we have in this year? 0. The total amount of depreciation we have, 80 plus 48 plus 22, once again, 150. All right, so on the exam, this is the way you're going to do it. In practice, most firms do something slightly differently. What they do is, at a certain point, they will switch from double declining to straight line because there's a problem conceptually with what they're doing right here. The problem is that they're saying no depreciation expense in this period. Well, the matching principle says if you have revenue, you should match expenses to it. This is saying that we have a 5-year useful life, and at the same time we're saying, no, we only have a 3-year useful life. So we're kind of contradicting ourselves. So to avoid that contradiction, many firms, at a certain point, and we'll get into the details, will change to straight lines. For example, what they might do is they might take this 22,000 and spread that evenly over these last 3 years, so none of them are 0. The book has a description of this. We will not talk about the specifics, and I won't ask you to do it. But most firms that use double declining or any kind of declining balance method will switch to straight line at a certain point in the life of the asset, so they don't have zeros. For our exercises in here, just make them 0. We're okay. Sound good?
Mhm.
Right. Units of production is our last method, and we're going to take our depreciable base, and we're going to multiply that by the number of units that they produced in this first year, 20,000, divided by the total number of units they expect to produce, which is 55,000. Or in other words, they've used up this percentage of the total usefulness of this asset. And so they're going to get rid of that portion of the asset and allocate those costs to this period, which is going to end up being 54,545. In our second period, they produced 10,000 units of a total estimated 55,000, which gives them depreciation of 27,273. Same in the second period, or in the third period, because that's the same number of units that they produced. Same in this period, because in years 2, 3, and 4 they all did the same. And in the last period they produced 5,000 units. What am I assuming here? Or what does this problem say happened? What is unrealistic about this problem that we just did? This one right here.
The same revenue from
No, that's not. Yep.
Are the projected that they only would produce that amount of units?
So we estimated that we were going to produce 55, and
That's exactly what
we produced exactly 55 in the 5 years. Is that ever going to happen? No, not even close, right? We're always going to be off. In this problem, we made it really simple, and we said our estimate was exactly right. That's never going to happen. But we're going to make our lives easier in this case, and I'm going to say that it actually did. And so we add all these all up, and we end up with 150,000 as our depreciation. In all of these cases, we have this cost. We are allocating it to these 5 periods. We just allocate them differently according to what method we choose. Firms can choose whatever method they want, as long as they can convince whoever asks that it's rational and, what was the other word?
Systematic.
Systematic, thank you. Systematic and rational. They can convince you that it's systematic and rational, they can do it. Any one of these 4 methods is acceptable. Plus, any other method you can think of. But these are the most common. And I think I have this on the next page. I have it a little bit later. I'll mention that this method is by far, like 95% of the time, the most commonly used method. For a number of reasons, and we'll talk about that here in just a couple minutes. But straight line is by far the most used method for depreciating assets. But you can use any other method that you determine is systematic and rational. You can use it. All right, so these are full periods. Each one of these periods is a full 12 months. Well, how often do we buy assets and then dispose of them on January 1st and December 31st. How often does that happen? Never, because no one works on January 1st and December 31st. We all have those days off, well, at least January 1st. And so firms buy assets on days other than January 1st, and they sell them on days other than December 31st. So we have to deal with, well, what happens when they buy them on a different day and sell them on a different day? And that's where partial periods come in. Depreciation, depletion, and amortization, the year of acquisition and year of disposal should be determined only for the part of the year that the asset is actually used. In other words, if you buy it December 1st, then you're only going to depreciate it for December, 1/12 of a year, and then the next year you'll do it for a full year. And then if you dispose of it in July, then you're only going to depreciate it through July, you're not going to depreciate it for the rest of the year. It's gone anyway, so you won't depreciate it. And so only when we have it and are using it are we going to be depreciating these assets. Many companies adopt a simplifying assumption for computing partial year depreciation. A common convention known as the half-year convention records 1/2 of a full year's depreciation in the year of acquisition and another half year in the year of disposal. So this is a kind of rule of thumb that many firms use. They basically say, on average, we buy it July 1st. Half of the time we buy it half before that, half after, and it's going to kind of wash out and be just fine. And many firms do that, and there's nothing wrong with that. We're not going to do that in this problem, but just be aware that many firms do that. So what we're going to do here in this problem right here is we're going to redo the previous example, so what we just did on the previous page, with one difference. We are acquiring the asset May 1st. That's the only difference, instead of January 1st. Everything else is exactly the same as the previous question. All right, so here let's start with straight line. So with straight line, we know for a full 12-month period, we're going to depreciate it $30,000. Well, we didn't have it for a full year in 2001 because we bought it May 1st, and so we only had it May, June, July, August, September, October, November, and December. 8 months out of 12 months. And so we're going to multiply this 30,000 by 8 divided by 12, and we're going to get depreciation our first year of 20,000. What about our second year?
30.
All 30, because we have 12 months worth, okay? This year, all 12 months. This year, all 12 months. This year, all 12 months. So last time, we didn't depreciate anything in 2006 because we assumed that we were going to have disposed of it at the end of 2005. But this time, we have pushed everything forward 4 months, so 4 months of this depreciation has now been pushed into 2006. So we're going to have the last 4 months worth of depreciation in 2006, 10,000. Add these all up, once again we depreciated a total of $150,000. Any questions about that?
Is it always going to be the last month?
Say that again.
Is it always going to be the last month?
The
Yeah, the remaining 4 months, is it always going to be the last month? I mean, like,
is it always going to be the last month?
yeah, like
The last year
Yes.
is meaning, you have to adjust to the last year.
you know, we use.
You're only going to have partial periods in the year of acquisition and the year of disposal. You're going to see here in a second what I just said is only sort of true. But for straight line, you're going to have a full year. All of the middle years, the only partial periods are going to be the first year and the last year. Did that answer your question?
Yeah.
Okay, good. So I wasn't sure what your question was, so I just started talking. Sometimes it works. Sometimes it confuses people more. All right. Sum of the year's digits. So we're going to just take the numbers from the previous page. It's going to make life easier. The way you need to be thinking about this is that for the first 12-month period, we're going to depreciate at $50,000. The first 12-month period has now been pushed. Instead of going from January 1st to December 31st, it's now been pushed forward. Pushed forward 4 months, and now 8 of the months are in the first year, and 4 of the months are in the second year. Or in other words, we're going to take the $50,000 that we would depreciate in the first 12 months. 8 out of 12 of those months are in this first year, so we're going to have $33,000. 333 in the first year. The other 4 months of this $50,000 per 12-month period gets pushed into 2002. So we have 50,000 times 4 divided by 12 for the first 4 months in this year. And then, starting May 1st of 2002, we start our second 12-month period. The next 8 months is the first 8 months in our second period, which was 40,000 per 12-month period. And so we're going to have 8 out of 12 of this 40,000 gives us 26,667. Add those together, and we get 43,334. So you see how everything's being pushed forward 4 months. We basically have, in this case, the last 4 months of the first period and the first 8 months of the second period. And then obviously, then the last 4 months of the second period will be pushed into 2003. So the 40,000 that is for the second 12-month period, 4 of those months come into this year, and we get 13,333. And then the 30,000, which goes in our third 12-month period, the first 8 months of that go into this year, and that's going to give us 33,333 in 2003. The last 4 months of this 30,000 per 12-month period gets pushed into 2004. And that's going to give us 10,000. And then the first 8 months of this 20,000 per 12-month period is here in 2004, which gives us 13,333, total of 23,333. And then the last 4 months of that $20,000 period, 4 divided by 12, gets pushed into 2005, 6,667. And then the last 12-month period, the first 8 months of it are in this year. And the last 4 months of it get pushed into 2006. So it's really, basically, you're just taking all of these 5 12-month periods and we're scooting them forward 4 months. And so in each year, at least the middle years, we have 4 months of one depreciation rate and 8 months of another depreciation rate. 4 months of one depreciation rate, 8 months of another. And then we have 8 months in the very first period and 4 months in the 6th year that we're looking at. Questions about that?
Yes, if you hadn't already done it for a full period,
You have to do that first.
you do.
Wow.
Yeah. So yeah, you have to do this part first before you can do this. You need that information. Yeah. All right. So add up how much depreciation we did. Once again, no surprise, 150,000. We still depreciate the same amount. Just now in slightly different periods because of when we acquired it. Now, if you think about all of the hundreds and thousands of assets that firms acquire, you can see why they might want to do a simplifying assumption of half-year convention, so they don't have to keep track of when they acquire and dispose of all their assets. And that's fine if they do that, but many firms do keep track of each individual asset, at least ones that are significant. All right, double declining is going to look very similar to what we just did. We have our first period, which is 80,000 per 12-month period. We have 8/12 of that, which gives us 53,333 in our first year, 2001. And then we have the last 4 months of that 80,000, excuse me, which gives us 26,667. Our second 12-month period, if you look back to the previous page, was 48,000. We're going to get 8 of those months. 32,000, add those together, and we get 58,667. And then we have the last 4 months of the 48,000 per 12-month period, and that's going to give us 16,000. And then we have the first 8 months of the 22,000 per 12-month period. We get the first 8 months of it, which gives us 14,667. Add those together, we get 30,667. And then finally, the last 4 months that we actually depreciate this in the way that we're doing it, 7,333, and then 0 and 0 once again. And obviously, we're not depreciating for the last 8 months here, but for the year, it's 7,333. Add them all up, once again, we get 150,000. So all of these are depreciating the same amount, just putting the expenses in different periods according to what method we choose, and if it's a full year or a partial period. Any questions on any of that?
We didn't have the same issue with the residual value as we did.
We did, and we stopped at 22, just as we did last time.
Oh, okay. And can you remind me how you got 22 and?
Yes, it's the 72, which is the book value, and we need to take the book value only down to 50. So going from 72 to 50, the difference is 22. All right, so a question that I always hope someone asks is there's 4 columns on this page and 3 columns on the other page.
Units of production is not being
Perfect. Units of production, it does not matter how long we have it. If we produce the same amount, it doesn't matter if we bought it in May or January or December 31st. However much we use it, that's the only thing that matters. So partial periods do not affect units of production. So it would be exactly the same, assuming we produce the same amount in those periods, in those years.
Can you push it a paper up there? You can see the line.
Did you want the next page or this one? So assuming we still produce these in the same years, so we still produce 20,000 during 2001, even if it was only 8 months, it'd still be the same number.
Well, when you're accounting for that, it's 1 and 5 are different. Like you produce more in year 1 and less than year 5, it's the same amount in both 3 years. I don't know, maybe not. Because if you bought it in May, it would produce less
Yeah,
than
yeah.
over a full year.
Yes.
And then if you
Correct.
sell it, so it's kind of already.
Correct, it would naturally happen, because if you only had it for a month, you wouldn't produce very much, and so it would naturally be less, so yes, you're exactly right. It naturally fixes itself. Very good.